Will the rally continue into year end? Joining us now is Cameron Dawson, Chief Market Strategist with Fieldpoint Private. $5 billion in total wealth management assets. Cameron, what are you telling your clients to do after some pretty significant gains in this latest little melt up 8 days in a row for the S&P?
Yes, so we think that there is reason to believe that this market should take a pause in the very near term, but then from there rally into year end. The rationale for a pause in the very near term is just that we see the S&P 500 as the most overbought or the most extended versus its trend since times like April of 2021, September of 2020, and even January of 2018. So what happened after each of those times was a period of digestion and some consolidation. But we don't think any weakness will last very long this time around, at least going into year end, because there are a lot of tailwinds at the back of this market, including things like liquidity, better growth expectations from infrastructure, and seasonality. But one thing to highlight is that there is very bullish signals when we look under the surface of this market. So we're starting to see cyclical and risk-on assets outperform. So small caps making new all-time highs and looking better relative is a really good sign for risk-taking, while defenses are simply being left out in the cold. So staples making new lows, relative lows, utilities making new relative lows, just shows that people aren't moving to defensive positioning, late cycle positioning, and that all is good news for the underlying dynamics of this market.
So Cameron, does that set up the strategy for 2022? Is that still where you want to be in some of the cyclical names because you're encouraged by all the signs in the market?
We think at least in the beginning parts of 2022, but we do expect returns to be quite a bit lower as we move into 2022. If we take a step back, the reality is we are coming off of 3 extraordinarily strong years of returns for the S&P 500. We had almost 30% in 2019, 16% in 2020, and then 25% now in 2021. To make it a 4th year in a row of returns over 15% wouldn't just be rare, it would be exceedingly rare. It's only happened ever one other time in history, which was during the tech equity bubble in the late 90s. So our expectation is lower returns in 2022 overall, and that makes sense from a fundamental perspective. We think that multiples will come under pressure as the Fed continues to tighten, and earnings growth will slow, most definitely from these very high levels in 2021, which just means that earnings won't be able to offset that multiple compression as much. So we're still positive, but we have lower growth expectations for next year.
Are we set for a period of a stronger US dollar, Cameron, and does that alter how you're allocating assets?
So we are seeing resilience in the U.S. dollar, much to the surprise of a lot of people who thought that there would be dollar debasement going into the beginning of this year, given the fact that we had a lot of fiscal and monetary stimulus. But the dollar has been resilient, which is a key risk for this market. If we continue to see higher upward pressure on the dollar, that will kind of do the Fed's tightening for them. That will tighten financial conditions and likely end up putting pressure on those cyclicals down the road. So we have to watch the dollar very carefully as a key risk for this market.